Welcome, everyone. We always appreciate everyone joining us. We are really trying to be diligent to get back with you at minimum every quarter, so we appreciate you taking time this evening. Just a couple basics. We will be monitoring the chat box as well as the raised hand feature to address questions as we go. We certainly always welcome it being interactive. As well as please note, if you have to jump off early, we will be taping this and running it in place of our coffee and cash this coming Sunday. So with that, I will hand it off to Darren to get started on a recap.
Thanks, Audra. Good afternoon, good evening, everyone. Great to have you with us tonight and appreciate your time. Hopefully you're enjoying the summer so far, and hard to believe that we're already almost midway through August. We're going to jump straight in. And again, as you mostly know, the format is really to try and give you an overview of some of the main changes that we recently made in our client models and accounts over the last couple of weeks. And just kind of give you a little bit of background in terms of what we're looking at in the markets and the economy, and certainly give an opportunity to answer questions. So let me dive straight in and we'll get going in the interest of time. So 2023 so far has been a really interesting year. Obviously, we all know that last year was a really tough one in the markets. Almost all areas of the financial markets really suffered last year, from stocks all the way through to bonds. This year has been certainly a welcomed relief so far, but we certainly entered the year with a fairly defensive view. And those of you who were on our previous webinars and sessions would have known that. And there were a couple of main reasons for that conservatism and defensiveness. Obviously inflation last year was one of the major topics that really drove the market down, really because it forced the Fed to raise interest rates so aggressively. So inflation was one of those major topics of concern for us, and just saying, hey, let's wait and see whether or not the Fed can be fairly successful at reducing inflation over time. Obviously, certainly recession concerns and concerns that maybe the economy would slow down pretty drastically as a result of the rate hikes we saw. Concerns about unintended consequences of the rate hikes. We rose interest rates and raised rates at the fastest pace that we had in about 5 to 6 decades in 2022. And so ultimately, when you do that, things tend to break kind of by design of raising rates aggressively to try and break inflation. And so ultimately, the banking issues that we saw with a select number of banks back in March of this year was an example of kind of unintended consequences of those rate hikes that tend, to certainly have ripple effects. So we wanted to kind of wait a little bit and see, as those rate hikes filtered through the economy, what some of those consequences might be. And certainly we did expect to see potentially some headwinds on corporate earnings and potentially lower profits. So we entered this year with a fairly defensive view and relatively conservative. And we certainly weren't alone. As you can kind of see in this little stat that I pulled from a few weeks ago, each year, there are some, pretty smart, pretty highly paid people called strategists that work for different banks, and the biggest banks like a JP Morgan or Bank of America. And their job is really to, kind of assess the markets and make some predictions and forecasts of where markets might end, maybe at the end of the year or maybe midway through the year. As most of you will know, we're not big believers in the practice of kind of forecasting and trying to make predictions. But it's really interesting to see that as of the end of July, the S&P 500 was ahead of 22 out of 23 of the year-end strategists' forecasts. So in other words, where these strategists expected the stock market to end the year, midway through the year, it had already blown through 22 out of 23 of those strategists' forecasts. So I think the market strength this year has surprised certainly a lot of people. So far this year, markets have done much better than certainly we expected, which is obviously always a welcomed sign. Bond markets have kind of surprisingly struggled to gain a little bit of momentum. The labor market has been really resilient, which is extremely important in the US economy. Roughly 70% of US economic growth and activity is as the result of the consumer. So a resilient consumer, strong labor market, things of that nature tend to really support the economy and the stock market. Inflation numbers have been coming down pretty consistently. And obviously, the big kind of theme in the market this year has been the excitement surrounding artificial intelligence and that kind of boom that's fueled a very narrow rally in the largest tech companies this year. So let's take a couple of minutes. We're going to dive through a couple of slides here together to kind of walk through some of the major themes so far this year. For those of you who have been on past webinars would have seen this chart over and over. And we keep coming back to keeping an eye on inflation, because at the end of the day, what happens with inflation is going to be very significant in terms of the impact and the path forward of really all the markets, stock markets, bond markets, and also real estate. And the reason for that, as we've explained in the past, is that if you don't have an inflation problem, you do not have to raise interest rates as aggressively as the Fed has done. And so the hope is that as inflation comes down, the Fed can really relax on the interest rate hikes, and hopefully things can stabilize just a little bit. So the good news is that inflation has come down significantly. We can see kind of this time last year, inflation peaked at just over 9%, and people were freaking out. Gas prices, which is in green here, were very, very significantly higher than what people had expected in the past. And so the welcomed news on the headline is that, inflation's really declined pretty consistently over the months since June of last year. So that's a really good thing. Most recently taken a reading at about 3% year over year increase, which is certainly a lot better than it was last year. A couple of things to point out, though. The Fed's target long term is about 2%. Which again is something that I think might take a little bit of time to get down to. The reason is that a lot of the low-hanging fruit in terms of the inflation drivers, such as gas prices and things of that nature, have kind of already come down. And you can actually see from this chart in green that the gas price is actually a negative contributor to inflation. In other words, it's detracting from inflation as opposed to this time last year. So that's a good thing. But these dark blue lines over here towards the bottom, those are generally stickier components of inflation, such as housing in the form of rent, right? So those types of inflation drivers don't necessarily change as quickly in response to inflation spikes, but they also don't come down as quickly once things start to subside. So I think, the big challenge for the Fed will be to say, hey, in the coming months, do we start to see even the more sticky components of inflation start to subside? I certainly hope so. The trends seem to be relatively good. It is also important to know that the Fed tracks a couple of different measures of inflation. This is CPI, which is probably down the lowest. The other measures that the Fed tends to track are kind of closer to 4.5% at the moment. So still some work to be done before the Fed, I think, will feel really comfortable taking their foot off the gas on interest rate hikes. But we do expect that we're pretty close to being done on the interest rate hike cycle, if not potentially already done, depending on the data that we see in the coming weeks and months. I mentioned at the start that market performance has been very narrow. What do I mean by that? Well, when you look at the stock market, obviously it's made up of a number of different companies. At the end of the day, to see a healthy stock market, you generally want to see a fairly broad rally. You want to see companies from many different sectors do well, right? You want to see broad-based gains, not just gains in a very narrow section of the stock market. And so what we've seen this year is, on a headline number, and this chart really goes through the end of June, so it's slightly outdated. We've seen a bit more of a widening out in the last month. But on a headline number in blue, the S&P at the end of June was up about 16%. So you might look at that and just say, oh, okay, pretty good. The stock market's doing quite nicely this year, a pretty good rebound, pretty good rally. But what's really important to understand is that if you look a little bit deeper beneath the surface, really the mega cap or major big tech companies have been the main driver of most of the returns year to date. You can see that just 8 companies, which I'll name them: Apple, Microsoft, Alphabet, so that's Google, Amazon, Nvidia, Tesla, Meta, and Netflix, all have done extremely well this year, struggled last year, have done really, really well this year. And so ultimately, those cumulatively by the end of June were up about 60%. So when you kind of look at that green line, and then the blue line, and then let's take the S&P 500 minus those 8 companies, basically the S&P 492, and they really have only been up about 3%, even though the headline number is up 16. So again, just understanding that, this rally so far year to date has been driven by a pretty narrow subset of the markets. And I think we just would prefer to see, obviously, a broader and more, widened rally to feel a little bit better about where we're at today. And certainly if you came into this year with a bit of an underweight towards large growth companies, or certainly an overweight towards value, which, we generally were towards the start of the year, that certainly has hurt returns. If you didn't have a lot of exposure to those 8 companies, you've certainly dragged a little bit this year as compared to where you otherwise may have been. I mentioned earlier that the consumer is really one of the keys to continue to watch relative to economic growth. Obviously, the consumer so far this year has been remarkably resilient, largely driven by the fact that the labor market is so solid. It's really been pretty cool to see. Even just yesterday, there was a small business survey that came out, and most small businesses still list labor and skilled labor as their primary challenge in the current environment, certainly way beyond inflation or interest rates or anything else of that nature. It's really just finding skilled labor, and the cost of skilled labor is really significant. So in general, the consumer seems to be in relatively good shape, but I would start to say that there is a little bit of deterioration occurring on the surface, at least, on the consumer in general. One measure of this is looking at what's called excess savings, right? So during COVID and during the pandemic, there was a massive increase in household excess savings, which was really a result of all of the different monetary programs that we ran. So things like stimulus checks, things of that nature, boosted unemployment. And so household savings just shot way up, $2 trillion at the peak, which is pretty staggering amounts of money for households to have. You can kind of see where household savings were pre-COVID and where they were after that. So a lot of the money that was created and printed certainly moved into that area. But ultimately, what we're seeing here is certainly a drawdown over time of those household excess savings, which is pretty significant. And so we've got to continue to watch that and ultimately see how we go. Audra, do you still see me? I know that you dropped off for a second there, but do you see me?
Yes.
Okay, cool. I've lost my video. I just want to try and get it back really quickly. There we go. So excess savings on the consumer side have certainly been dwindling, and that just means that people generally have less padding, less emergency funds, I guess, cash in the bank. At the same time, consumer debt is increasing quite significantly, about a 72% increase as opposed to where it was during 2008, which is not ideal. But at the same time, you have to understand a balance sheet, right? That assets and liabilities need to be considered. So consumer assets have also increased very significantly in the last 10 or so years. And so again, just important to balance that and counterbalance that. But debt certainly has been increasing in recent months and years. I like this chart because what this shows us is basically, I guess, the canary in the coal mine, where we should, from fairly early, start to see if there maybe is some weakness in the consumer through the chart that we have on the slide here, which is really looking at what's called delinquencies of 3 different types of consumer debt. Number 1 is auto loans, credit cards, and then student loans is in orange. And what we can see is that in the last number of months, we have started to see a fairly large uptick in the number of delinquencies or ultimately defaults on auto loans and credit cards, which is not a great sign. If you combine that, with obviously consumer debt increasing, excess savings going down, and early delinquencies rising, is generally not a great thing to see. Obviously, still fairly low by historical standards. So I don't think reason yet to be overly concerned, but certainly bears watching. I think what is really interesting is that the student loan line in orange has obviously been pretty much flatlined since COVID. And that's really because of the federal kind of pause on student loans and repayments, meaning that student loan borrowers have not had to pay any payments on their student loans. Therefore, delinquencies are zero because obviously no one's defaulting on loans they don't have to pay. But what will be really interesting will be to see in the coming months ultimately what happens to that orange line, right? As people have to start, working back into their budgets, student loan payments, which, as we all know, can be pretty significant. I'll be very interested to see if either that causes, credit card debt, for example, to run up, if it causes excess savings to get drawn down, or certainly if we start to see some delinquencies early on in that. I think that'll be a bit of a tell of the strength of the consumer more broadly. Lastly, we've been talking a little bit about recession for quite some time. Obviously, there's a lot of talk in the media and financial news about the recession that never was, right? We've, I think, been talking about recession and predicting recession for many, many, many years. And the old joke is, ultimately, 9 out of 10 economists, incorrectly predict recessions all the time. And I think that that's very true. But what's really interesting to look at just more generally in the economic data is something called leading economic indicators, which tends to generally historically be a pretty reliable indicator of ultimately the possibility and the probability of heading into recession. And the way to read this chart, for those of you who haven't seen it, is that these light gray areas over here are past recessions, right? So those are times when the economy went into recession. These blue lines are what are called leading economic indicators. So those would kind of take the pulse of the economy in different areas. So things like building permits, new orders for manufacturing, unemployment claims, things like that can generally give you a bit of a heads up of what might be coming down the line. And generally, when these economic indicators deteriorate, roughly, once they break down negative, roughly 6 to 12 months after that point, we tend to enter into recession. And you can kind of see the pattern. We deteriorate, we go negative, recession, deteriorate, negative, recession. And so that pattern's held very true for a long time. So if you kind of look to the far right here, if we look at how far these leading indicators have broken down, it would be historically without precedent if we were to break down that far and not go into some sort of recession, at least a fairly mild one. So it does bear watching. Again, this is a confusing time because you're contrasting certain data points like the labor market that looks really good against points like this that look really pretty negative and pretty bad. And again, you start to have these conflicting signals in the economy, which I think just makes it an extra difficult time, especially with the distortion that we're coming out from the pandemic with all the rates and all the different things we've done. It's kind of difficult to get a read on where things are going at the moment. So Audra, obviously one of the major things in the news was the debt downgrade in the last couple of weeks. Why don't you kind of talk us through a little bit of that, if you don't mind?
Absolutely. As always, we like to weave in some current events to help give some context. And this recent event we thought really would give you a sense of another factor in what we're experiencing. We've been talking about the downgrading of U.S. debt, which was put out by Fitch, which is one of the 3 predominant credit rating agencies. In addition, as early as this morning, Moody's has now downgraded several banks due to financial risks that could erode their profitability, with possible warnings of others to follow. First, what we thought would be important is to review the 2 reasons that Fitch gave for doing this downgrade. One is mounting U.S. debt. Certainly not anything that would be a huge surprise. We do read the news. We see things every night about where money is going. The second is continued erosion of governance. And what's meant by governance is the ability to manipulate the debt ceiling in and of itself. As you recall, in our last webinar, we actually talked about the debt ceiling and the implications if Congress opted not to raise the debt ceiling, what that might mean for the economy. However, we really didn't talk about the problem for the economy resulting from politicians consistently using the debt ceiling as leverage to get various agendas passed. One way to look at this status, this new status for the U.S. debt, is to liken it to an individual suffering from a drop in their credit score. If you had a credit score of 840, you are likely to have been able to obtain the best possible rates and approval when seeking a loan. Yet, if your score were to now slip to 750, you might be faced with having to do higher interest rates to borrow those same funds. This shift from being a AAA rated debt to AA plus causes the US to find itself being a greater credit risk to those it might seek to borrow from. So what would this actually mean for our current economic condition? Well, a few of the bullets that we have on our slide. Initially, it challenges the government's ability to obtain more debt, which is very much an ongoing activity. Certainly declining consumer confidence. It always gives all of us pause to see something of this magnitude. It can continue to slow economic growth and potentially accelerate a potential recession if we are headed in that direction. Could devalue the US dollar. And lastly, reducing the demand for US debt. The reason for this is, remember that many institutional investors are not able to hold things that are rated less than AAA. So they would have to divest from these debts. So in turn, that could reduce the demand. However, as always, we want to be glass half full in our webinar in looking forward. We still know that US Treasuries are considered some of the most reliable, steady investments out there. And we have every confidence that due to the volume of US securities that are sought after, that this will not likely be a grave moment for us moving forward.
Thanks, Audra. Yeah, I certainly just agree with that, and just kind of, reiterate that the facts, certainly we have seen a downgrade from AAA to AA plus, but AA plus is still a very, very strong credit rating. So there's, certainly some degree of concern. I think if nothing else, it helps to serve as a bit of a wake-up call, just for the way that we are fiscally managing the country. In other words, kind of being able to print as much money as we want and spend as much money as we want. I think we all inherently know that there's a limit to that. And I think that this kind of thing, quite frankly, by Fitch to do this is probably appropriate given what we've seen, right? If we likened it again, like Audra said, to an individual who suddenly was taking on all this extra debt, and yet their income wasn't going up, we would also probably downgrade and lower their FICO credit score. It's not unlike what we're doing with the US kind of government budget. So again, I just think a good wake up call in some ways, certainly not sparking the end of anything in life as we know it, but certainly something worth considering. And also remember that back in 2011, the S&P rating agency already downgraded US debt from AAA down to this AA plus status. So let's kind of dive in from there in terms of a discussion about the debt downgrade, which is obviously the most recent news that we had come our way, and kind of talk a little bit about the positioning of our client portfolios and kind of how we're looking at things at the moment. Most of you knew, and obviously, as I mentioned already early on in the call tonight, we entered this year with a relatively defensive positioning, certainly not all the way defensive and all the way bearish, but also not overly optimistic. In hindsight, it should have likely been more aggressive and certainly bought a lot more of those 8 companies that have done extremely well this year. But ultimately, what we're looking at right now is, really grappling with the question, which is in my mind the most pressing question, which is, have the negative factors that were there and present at the start of 2023 disappeared or merely just been delayed? And that's a difficult question. I think if we look at kind of what's driving and mainly influencing the markets right now, and the reason why things have done quite nicely so far is that there's obviously an increased expectations for effectively a soft landing, which is the perfect threading the needle of inflation coming down just right, while also not having a recession or any kind of negative movement in economic growth. So hopes for that have really increased, just seeing the resilience of the labor market and the economic data. Obviously, inflation continuing to decline, and the Fed being done or pretty close to being done. So I think that there are legitimate improvements on a few of the main factors at the beginning of the year that we were pretty concerned about. Obviously, again, inflation, the Fed being pretty close likely to the end of hikes. Those are both really positive, I think, more broadly. So what we've decided to do in third quarter is really kind of tick up a little bit in terms of getting back to more of a neutral stance. Why haven't we gone super offensive into the dark green over here? Well, I think that all things being equal, I'm glad certainly that the market has done what it's done this year and that it's done quite well. But I think we have to be a little bit careful about assuming that the pace of the gains that we've seen so far this year will be repeated in the back half of the year. I think we've kind of run out pretty far ahead. There's a lot of very positive expectations and very positive assumptions built into the market and kind of underlying the market right now. And so I think, in many ways, not that I'm expecting necessarily a major correction from here, but I think certainly a 10 or so, 10, 15% pullback in the market at these levels wouldn't be unheard of, and certainly not overly unexpected, especially if we get some disappointment on certain data points in the coming weeks and months. But I do think it is appropriate, to acknowledge the fact that certain factors have certainly improved materially to kind of get back to a more neutral positioning. So what that would mean for you is if you're someone that maybe has historically been in a more moderate portfolio, let's say 50, 60% in stocks, whereas in second quarter, we may have been closer to the lower end of that range. Let's say if you were a 60-40, maybe you were at about 50%. Now you've ticked back to about 60%. So again, not going overly conservative, not necessarily overweighting stocks, but certainly kind of getting back to a more neutral standpoint, which I think should help us to do a little bit better and participate a little bit more in the upside if things continue to do well. A couple of important aspects and a bit of background to kind of explain what we've done in this wave of trades. Bonds over the last decade have been pretty boring. They really haven't done a whole lot. Rates have been really low and pretty meager, and stocks have absolutely outperformed the bond side of the equation. Important to understand, though, that bond prices declined really significantly last year. They got, pretty much, I think bonds had about the worst return in an annual calendar year that they had had in about a century. So it was really, really pretty horrible. But the upside of that is that ultimately there are a lot of bonds that are trading well below what's called their par value. And to understand what that means, bonds, when they're issued, are issued at a certain dollar amount, let's say $100, and they mature at $100. In between issuance and maturity, the price can fluctuate all over the place as it did last year. However, at a point in that maturity, assuming that the person who borrowed the money can pay you back, you will get that $100 back with your interest. And so right now, if you look across the universe of average bonds in the US, even high quality bonds are trading at around high 80s, early 90s in terms of maybe $90 per bond that is going to mature at 100 in the next 3 to 5 years, while paying now about a 4.5 to 5.5% yield. So pretty attractive. And what I think is really interesting is that, when we're looking at investments, you're trying to look for an investment ideally that has a higher probability of giving you more upside than downside, right? So you're looking for what's called an asymmetric return profile, which that can be your nerdy word of the night. Asymmetric return, right, is basically if you can get more upside than downside, that's a pretty attractive trade-off. So the main risk to bonds is certainly if rates continue to rise unexpectedly. And so let's say that rates do rise 1% further from here, which would be very unexpected. I think the market's pricing in a small chance of another 0.25%, but to get to 1 would be really significant. If that were to happen, you'd probably see a loss of about 1.5% in the broad bond market. But if rates fall or even stay where they are, let's say stay where they are, you're probably in the region of, let's say, 4.5 to 5% rate of return on bonds. Whereas if rates actually fall at some point next year, which is quite widely expected, then you could start to see a really significant boost to bond prices, and that could really do well. So when you look at just the highlighted box here, if rates fell, about 11% upside potential. If rates, rise, which would be a negative for bonds, there is some potential downside, but now there's enough yield to really kind of cushion you and really help to hold you up. So we're looking at bonds actually as quite attractive, which is the first time in a decade that we've said that, but I think that that's something worth watching. So we've made some tweaks to the bond piece. I've also mentioned over the last number of calls the concept of buffers and buffered ETFs, which we've used pretty extensively over the last little while. We just added a little bit more to a buffer in this most recent trade cycle. And so just as a quick recap for those of you who aren't familiar with these or understand how they work, a buffer is effectively a stock fund. It tracks the stock market. But at the beginning of a 12-month period, basically the fund sets where its buffer is, where its protection is, and also where its cap is. So it's best illustrated with an example. At the beginning of this period, we know that the buffer is negative 10%. In other words, if the market falls 10%, we're going to be protected in that first 10% of the drop. We're not going to feel it. And this is a really good example of that, where the stock market in gold actually ended this period of time, this 12-month period, down 10, and this fund ended flat for that period of time because you do not participate in the first 10% of the drop in the market. So pretty attractive. But what's the trade-off? The trade-off is that you can't have protection on the downside with no give up on the upside, right? So the give up is ultimately what's called a cap, that if the market runs out really strongly ahead, you will only get a maximum of the cap and whatever it is at that time. In this scenario, the cap was 13.7%, but the market went up 30%. So obviously you certainly gave up some upside potential in that scenario. But again, the reason that these are interesting is because you have some good protection if things go badly, but you also have some pretty good opportunity to participate on the upside if things go badly. So what we just did in our most recent change is we implemented a new buffer just for about 5% of most accounts. So this is, again, one of the ways that we're looking to kind of get back to a more neutral stance, is to increase exposure to stocks, but to do so in a relatively moderate and fairly defensive way, just to protect ourselves in case things turn around from here, is ultimately we added a buffer of 10%. So we have kind of 10% protection if the market falls from here, but the cap is about 17%. So ultimately, if the market goes up about 17% higher from where it is today, we'll get all of that upside. If it goes above 17, we'll still only get to 17, but we do have that 10% protection in the short term if things go badly. So that's been one of the changes that we've made. On the stock side of things, we were previously a little bit overweight to large value stocks. We did reduce the overweight earlier this year, and now we're back to a bit more of a balanced kind of weighting between those two sides. Why are we not abandoning value and going all after the growth stuff that's done so well? Well, because in most part, as we know, we don't want to be those investors that buy at a high point. You kind of want to wait, and kind of look to add money to things that have not yet done very well, right? So you're buying at a lower point is ultimately where we want to be. But at the same time, we need to make sure that we have relatively good exposure to the area of the market that certainly has some momentum. So again, kind of edging our way back into there and increasing our weighting a little bit towards growth and slightly reducing our overweight towards large value. On the bond side, I mentioned some opportunities there. The way to take advantage of the opportunities is to hold slightly longer term bonds than what we've been holding right now. So increasing the length of what's called duration is sensitivity to interest rates. From 4 years to 5 years is a good way to do that, to ultimately get more upside if rates do get cut, and certainly to recoup more yield if things kind of stay where they are right now. We ensured adequate cash was in place and increased securitized bonds, which are currently trading at a pretty significant discount at the moment. So again, those are kind of high-level overviews in terms of what we've been working on. Shifting back to a more neutral stance. after seeing some fairly positive developments in some economic data, still continuing to be a little bit cautious relative to those leading economic indicators on the recession chart that I showed earlier, and continuing to lean into certain areas of the market that have attractive risk and reward trade-offs, like bonds, like buffered ETFs, and the like. Audra, do you have anything to add just on kind of the most recent wave of trades or model changes or anything like that?
No, certainly, another reminder to those who maybe have been cautiously retaining more cash on hand. We still do have opportunities, not only with money market having a very attractive yield for the first time in a long time, but access to CD options. So certainly we always invite everyone to reach out. We're happy to share current rates as they do fluctuate, throughout a given week. But you're always welcome to reach out and we'll share what we have.
Absolutely. And if anyone wants us to take a look at kind of outside investment accounts, we're certainly happy to take a look at those and give them a look and over for you. Audra, do you see any questions that have come through? Certainly, if at any point you want to submit a question, please feel free to type it into the Q&A or the chat box. We'd be happy to take that for you.
Yep, so far nothing.
Let's give it another minute or so. All right, but if there are no questions, we'll give you back some time on your evening.
Oh, I have one. Market neutral. Can you define that, Darren?
Let's see here. So Barry, I'm wondering, are you referring to this neutral here on the dial or market neutral in terms of the holding that we've been using as a bond alternative? Let me give you a second to respond to that for me, just to clarify. Thank you, Joe. We appreciate that. Always encouraging. Thank you. While Barry's answering that, let me just kind of expand. So we do have a couple of holdings in our portfolio and in our models called a market neutral holding. What that is really a bond alternative, right? So when you're looking at the environment we were in last year, it was a horrible environment for stocks and for bonds. That's pretty unusual. Usually when stocks are already struggling, bonds tend to do well. But because of what was driving the turmoil last year with rising interest rates, stocks and bonds both got hit pretty badly. So market neutral is an approach where ultimately you are aiming to achieve the characteristics of a bond, which is really income and stability and, a low correlation to stocks. But in a way that isn't necessarily using traditional bonds. So what these particular funds do is they might, buy a high dividend paying stock. Let's say that they buy like a Verizon or AT&T or something that's paying 5-6% dividends. And then they subsequently go and they actually short the stock. So that means that you make money when it goes down. So you own it, you make money when it goes up. But if it goes up, you also lose money on your short position. So you basically are neutral. And all you're doing is really collecting the dividend that stock is paying. So it's a really effective way of reducing exposure to bonds and to the issues that bonds were having last year, but ultimately have been really effective. We still continue to hold them, but we are moving a little bit lighter on market neutral and moving more money into traditional bonds, which I think have more upside potential in the coming year.
Darren, I do have two additional questions. Either one of us could probably take them. I'll give you the first one. How is this approach affected by age and proximity to retirement? So I don't know if you want to take that. And then I have a question on CD rates. So
Sure. Yeah, I mean, so listen, age and proximity to retirement is one of the major drivers of risk in your portfolio. It always should be. At the end of the day, the general rule is obviously the closer you are to retirement and the older you are, slightly more conservative you want to be. I would note that that is not always the perfect general rule of thumb. As with any rule of thumbs, they have shortfalls. I think you have to look at your big picture financial situation before making any kind of assessment of risk in your portfolio. As an example, you might be pretty close to retirement. You might even be in retirement, and a little bit on the wiser, older side of the equation. But the reality is that if you have resources that are, far in excess of what you reasonably might need for your lifestyle, you have really two different choices. You can either go really conservative because you say, well, why would I take on excessive risk if I don't have to? Or the other side is, well, I have more than I likely will need, so let's swing for the fences and try to be really aggressive. So you can really go either way on that. I would say the best thing to think about as you approach retirement is less, what ratio of stocks do I have, bonds, but more, what's my access to cash and short-term safe liquid cash that I might need to support my living, right? So I think that's the major thing, kind of thinking about it in terms of buckets, where in your short-term bucket number one, you want to make sure that you have adequate amount of cash. As long as you have cash, the greatest risk for a retiree is not seeing their account values go up and down. It's just not having access to cash when they need it and being forced to sell stocks or other investments at a really bad time. So it's a long-winded way of answering that question. But again, I think it's all about context in your own personal situation.
The other question we had is, are CD rates of 4.5% a good deal? I think I could speak to that. That certainly that is attractive compared to where they've been for quite a long time. Depending on the term of the CD, we are seeing things north of that, even north of 5%. Right now, in general, the shorter terms, such as a 12-month, usually has been seen to be paying a higher rate than an 18-month or a 24 or a 36-month. And again, I think that's just with the anticipation that there's still some movement that might be happening. So to maybe do something in a ladder form, or you're dividing things across different time periods. 4.5 isn't bad, but I think certainly there are other options out there that are paying a little bit better, and we're always happy to share what intel we have.
Audra, I actually just pulled up some rates that we were looking at yesterday for retirement. And these are subject to change, so they change every day. But 12 months were at 5.3, 18 months at 5.2, and 24 months at just over 5.05. So, again, you've got to factor in fees and things. We can help you figure out, the comparison between maybe a CD at a bank. But I do think that you can, 4.5 is not bad, depends on the term, but you can probably squeeze a little bit more out of that, kind of shopping the broader market of CDs at the moment.
All right, that looks like all of our questions. So thanks again, everyone. We always enjoy putting information out there. Reach out anytime and we can expand on these topics.
Absolutely. Thank you all so much for joining us, and we hope to see you again soon. Have a good one.
Good night.